Is buying stocks more profitable than buying real estate? Should you finally let go of your rented apartment and purchase the house of your dreams outside of the city? Well, the answer is clear. It depends. The S&P 500 index returns a staggering 10% annual return. Surely the housing market cannot keep up with that. And no, it can't. But when purchasing real estate as an investment, there's two very important aspects to consider. Those are taxes and gearing. But before we get into that, let's look at the growth rates for a few different cities in the UK. First off, London. London has seen an average annual return of 5.7%. That's big, and it's as expected. London is a place of business, culture, and a place of growth. But what if we move a little bit outside of London? Reading is a smaller town about 65 kilometers west of London, and you would expect it to have a much lower growth rate than London, right? Well, in the past 25 years, Reading has actually grown by 4.9% annually. Now, that's pretty impressive. You would almost have the same return as if you had bought a flat in central London. Okay, what about some of the cities further away? Let's look at Liverpool. It's still a big city, but nowhere near London. Well, if you take a closer look, you would see that Liverpool has grown a whopping 6.4% every single year. That's even more than London has. This brings us to one of the first lessons of the housing market. When prices get too high in a certain city, the growth typically tends to slow down. What then happens is that the growth rates spread to nearby locations, or perhaps cities that's similar in infrastructure, job, and opportunities, like Liverpool, for instance. There's a lot more we could say about these dynamics, but the big thing to remember here is that different cities grow at different speeds. We have places here in Denmark that have seen 0% growth rate for the past 25 years. So before you're into the housing market, make sure you're purchasing in an attractive area. What can you expect from the stock market? Well, if we take the S&P 500 as our example, you would have seen a 9.4% annual return for the past 25 years. Okay, so real estate in Liverpool grants 6.4% annual return. The S&P 500 grants 9.4%. So surely investing all of your money in stocks is going to be the better financial option. Well, not necessarily, and it all comes down to taxes. If you bought your house for $1 million and sold it for $2 million, you would be looking into $1 million of profit, or 100% return. Now, here in Europe, for most countries, and also for most places in America, you're looking at about 0% tax when it comes to your primary residence. Now, the tax rules varies depending on location, and it also varies depending on certain criteria. So make sure you look into your local tax laws before you make any of these decisions. But for the vast majority of places here in the West, these are the rules. So how do you figure out what investment makes the most sense for you? Well, you need to figure out what the growth rates have been in the areas you're looking to purchase at. This can be done through Googling or perhaps just asking ChatGPT. It's really not that difficult to find. If you for some reason cannot find it, you can actually calculate it yourself. Go and find similar houses in the area and look at the latest selling prices. If you then go a few years back and look at the same houses and what they were sold for then, you can use this formula to calculate the annual growth. Once you have calculated the average return in your area, it's time to find the net return of the S&P 500 index or whatever else investment you're choosing. These calculations are all done given your tax bracket. These calculations are a bit too difficult for what I would like to include in the video, so instead I have calculated them for you. Here you see the S&P 500 net return given whatever tax bracket you're in. Now, I do realize I only have 10, 20, and 30%, but you could always just estimate that, well, if your tax is in between two, you're going to be in between those 2 points. Okay, so with this information, we see that even if your country has a 30% tax level, you would still be better off purchasing the S&P 500 than investing in Liverpool, which really was the greatest investment of my examples previously. However, there is still one very important aspect to consider, and that's gearing. Usually when you purchase a house, you don't pay the entire amount up front. Let's say that you purchase a house for $1 million and you only put $200,000 of your own money in. The rest is covered by a loan. Or imagine that the value of your house increases by a mere 5%. That's $50,000 in profit. Well, because you only put $200,000 of your own money in, that's a return of 25% on the money that you invested. Now, this is the power of gearing. In real estate, you often borrow to invest, and that means that your actual return is multiplied greatly. That's why even a 4 to 6% growth rate can be extremely profitable. But of course, gearing is a double-edged sword. If the prices fall, your loss is also magnified greatly. But historically, and especially if you live there long enough, the housing market has a tendency to go up. Now, yes, if you purchase your house in 2007 and the financial crisis happened, it might take a little bit of time for you to regain that money. But it comes, and it often comes quickly. How long you have to wait and when you should time the market is a different video though. These days, sadly, you have to pay interest rate on your loans. Now, I have just purchased a new home myself, and the interest rate that I was given was 4%. So let's use that interest rate in our example earlier. In our example, we purchased a house for $1 million. $200,000 came from our own pocket, so we only have to pay interest rate for $800,000. Now, 4% of $800,000 is $32,000. If the house went up by 5% in value, that means that our net profit for that year is the $50,000 in profit minus the $32,000 we have to pay in interest. That's $18,000 USD. But remember, we have to see the $18,000 in relation to the $200,000 investment we made ourselves. That means that our return that year was an actual 9%. Let's look at Liverpool for a second. It was the most profitable example that I made earlier. And Liverpool saw an average annual return of 6.4%. Now, if we use the example we had earlier, but with the new average annual return, you would be looking at an extreme 16% return every single year. So there you have it. There's two really good reasons why you should purchase real estate over stocks. But remember, it all depends on where you choose to purchase the real estate, if it's your primary residence, and whatever tax laws there is in your local area. And there's of course a lot more we could cover in this video. For instance, if you're renting, you're paying rent every single month, and that goes directly out of your pocket into someone else's pocket. Of course, there's some tax deductions there, but let's keep that out of the way. Whereas if you take up a mortgage, your monthly rent is simply paying yourself, but later in life, because you're purchasing more and more of your own home every single month. But I would like to keep this video short and precise. I think the real message here is that it can be really, really profitable to purchase home for yourself. So if you have the chance to save up to do so, it might just be the best investment you're gonna make your entire life. And I don't say that lightly. Now, if there's anything else you would like to have covered, let me know in the comments, and please subscribe. It helps me make these videos. So thank you very much for watching, and I will see you in the next one.